Hello, everybody. Welcome to another installment of our Southern California housing market update for November 9th, 2021. My name is Stephen Mead with Domicile Real Estate, where we are on a mission to help California's renters become homeowners. And we believe that, real estate is for people who love houses too. So let's talk a little bit about being wrong and being right, because I think that there's kind of a lot of that in the market. I think I've mentioned this a couple times before, but I haven't maybe mentioned this lately. For those of you just tuning in, my actual college degree is in economics, especially with bigger markets. I loved real estate as a market when I was in college. And I am here to tell you that no matter what economic outcome you are predicting in the housing market, you probably can find an economist who will be saying that is what is going to happen. And you might be asking yourself, well, how do I know who is right and who is wrong? And the answer to that is a little bit more complicated, and it sounds like a non sequitur, right? Everybody is right most of the time, eventually, and just about everybody is wrong in the short run. So one of the things that I think is interesting when trying to make these decisions is that we often don't realize, and we, I mean the collective we, right? And especially buyers and sellers, I think they get an idea in the market of a prediction, right? Based on some of the personal factors that they think is going to happen. And then they look for signs to support that, kind of a confirmation bias. And I think you have to be very careful in real estate. Real estate is such a big deal and part of your net worth that I think your temptation is to want to predict that. So whether you're a buyer, right, who's going into the market, you're going to have your own kind of set of predictions. Or if you're a seller, you're going to have your own set of predictions. And the biggest problem with this is that being wrong feels exactly the way as being right in the moment. And a good example of that, right, is kind of that duality is some people are saying the market can't keep going up forever. Factually, I would say this is a true statement, but the question is, well, okay, so if the market can't keep going up forever, when is it going to stop going up? And if it stops going up and goes down, how much is it going to go down and over what period of time? These are all very important parameters. If I told you 2 years from now, the market will go down 2%, as a buyer today in an up market, I don't think you really, that really matters very much to you, right? If you're a seller, I don't think that scares you that much either. So you have to understand these parameters, that the how much and by when are the hard part of predicting. It's not predicting that the market may go down at some point. In fact, historically, the real estate market does not go up forever. It is not just a continual climb with leveling off steps. And that kind of brings me a little bit to our market today, kind of going through the graphs. And I think what's happens is, what I'm seeing is this trend in our market where we have an equilibrium and we kind of find this spot where things are humming along, and then something changes, right? Something changes, and then the market kind of scrambles and adjusts to sort of a new equilibrium point. This isn't that unusual from most years. It's just we're not used to this equilibrium seeking happening in the fall like this. So let's jump into the stats, and I'm going to explain what I'm talking about in our Southern California market here so that you can get a good grasp of how this is affecting things. Okay, so we're going to go all the way back up here to our beginning on our total active listings. So one of the things that we're seeing here is that these active listings are dropping off faster than we could have anticipated. And that's happening both in our under 1 million and our 1 to 2 million. Just as a reminder, everyone, this is for Los Angeles and Orange counties. If you're elsewhere, this data might be a little bit different. I would say we are on pace to be down about 20% on inventory versus where we were last fall around the same time. So year over year, down about 15 to 20%. So you're watching your selection dwindle a little bit, still not as bad as it was at the low point here for under 1 million, and actually a little bit worse than we were at our low point for our 1 to 2 million. If we look at our new listings on the market, that's where something kind of interesting has happened. We saw this falling, right? And then it took a real deep dive. And I'm looking at this and I'm trying to determine, is this a true bounce in the market? We've kind of hit this floor of the minimum number of listings, new listings that come into the market, or did we just have a particularly bad week last week? And if you draw a line like this, you'll see this new data point is right in line with that. I'm not entirely sure about that yet, but I feel like what's happened is, this is our heyday of our maximum new listings through the summer. And then we've kind of adjusted to sort of this new equilibrium point down around in this zone. If you look down here, we kind of see something similar happening in our 1 to 2 million category. We are right where we were at the sort of the beginning of January in terms of new listing volume. Now, if you look here in terms of our new escrows, that has also been falling, but in a much more gentle way. And that also leveled off a little bit. What I think is fascinating is in this 1 to 2 million category, the red line, it's never really fallen very much. I mean, this has been pretty steady the whole way through. That tells you that these buyers in this $1 to $2 million range are fundamentally different than the buyers under 1 million. That's actually the reason why we break this out, because this is commonly the case. So if we combine this together, right, if this is our supply here, our new listings coming to the market, and this is our demand, which has been a much more gentle slope as interest rates have kind of risen and prices have gone up, this is our absorption rate. So what I want to talk about here is that you see where our absorption rate has been through kind of most of the spring and the summer, right? For our under 1 million, it's been kind of hovering in that 80 to 90% range. And then it's been kind of 80 to, maybe 85% here for our 1 to 2 million. And then you see something interesting happened around September. These numbers started heading upwards for both of our price ranges. And what this means is that that relationship of supply and demand fundamentally shifted. And I think where we are now we see this easing a little bit. I think where we are now is it looks like things have finally caught up and we're sort of entering sort of a new equilibrium point with a little bit of stability. What scares me though is we are still above 90%. This is a very competitive equilibrium point. And anecdotally in the field, I like to talk to a lot of my colleagues, in the field, and I always ask them, how are things going for you? And what we're noticing is this. We're seeing this bifurcation of demand, right? We're seeing buyers are pickier. That makes a lot of sense. Prices are higher. Buyers are going to be pickier. And we're seeing this concentration of demand on the most desirable homes. So yes, there are homes that are staying on the market for 30 days. And then there are those top tier of desirable homes, maybe the top 25% of attractiveness of homes. And those homes are getting multiple bids, and it feels like a circus, and it's just like what you expect. There's pressure to waive appraisal contingencies, et cetera. And if you're a seller, we're back to that scenario. There's kind of the haves and the have-nots. The have-nots see their house sit on the market for 30 days. The haves get a bunch of offers and feel like the belle of the ball. So, we're seeing that kind of strengthen as we head in towards the fall. But what it means is for those desirable properties, if you're a seller or buyer, things look a lot like they did earlier in the spring for you. Now, moving on to our price points. Just as a reminder, this is 4 to 6 weeks old. You see kind of this gentle graph. It actually looks almost like our prices have eased a little bit in that 75th percentile. I do think we're going to see this number swing up a little bit in the next couple of weeks. You look at our entry level though, isn't this interesting? Now we're starting to see the result of that market that started about a month ago, this more competitive fall market that we weren't anticipating. We're starting to see the results of that in these closed prices heading upward. This entry level 25th percentile, right? This is the area of the market that is probably the most competitive and moving the most price wise. Now, this is another measurement that we use called still active after 14 days. We look at all the homes that came up in the last 14 days and we say what percentage of them are still active or coming soon in the marketplace. You'll see we had kind of a low point, which was the most competitive. Then it rose up in the fall, but now we're kind of in this new equilibrium point here where things look pretty steady. I mean, we've got week-to-week fluctuations, but I think the trend line is pretty clear here if you're looking at this graph. So another sign that, our overall competitiveness, it's better than it is in the spring overall, but I'm telling you, if you're looking at one of those particularly attractive homes you're going to actually find that it might look a lot like earlier this spring. So, if you're, I'm going to take a pause here. If you're a buyer or seller, let me give you some sort of free advice, right? If you're a buyer and you're feeling frustrated, not finding what you want, look at the homes that aren't getting as much attention, because there's a huge difference in demand versus those top 25% homes and everything in that bottom 75%. If you are a seller, now is exactly that time that you really want to do whatever you can to be in that top 25%. Does that mean staging? Possibly on your price range, depending on what kind of house you have. Does that mean really working hard to prep the home before it goes on the market, having photos that put you in that top 25% of appeal to buyers? All of those things are very much worth it right now. Earlier in the spring, you could have had an outhouse and put a for sale sign out front and gotten multiple bids. That's not going to happen. But if you're one of those top quartile houses, that top 25%, you very much can get into a high desirability situation where you have buyers really kind of fighting for your property, especially if it's priced right. And kind of speaking of pricing, this close to list ratio I think is interesting. We kind of peaked here in June, which was relative to early May deals. And then we dropped back down, and I kind of expected this to fall back to about 100% as we closed out the year. I don't think that's going to happen. We again have reached kind of this equilibrium steady point. Look at the range we're trading in right now. Finally, I want to talk about days on market for new contracts. And just again, I know I've pointed this out a couple times, but gosh, this just really, this kind of sums up the differences between this year and last year. Look at where we were in December for average days on market of new escrows. 55 days for that 1 to 2 million category, and high 30s for that under 1 million category. And look at where we are today, a little over a month away from that point. Yes, we've seen some increases in this, but now it's bouncing around. Again, another sign that we've reached a new level of market equilibrium, right? Where this is sort of the new normal going forward. We're in the low 20s and the high 20s for that 1 to 2 million category. Looking at our affordability, and this is something I harp on because I think really this is that canary in the coal mine. If this graph suddenly takes a huge jump to like 120% plus, that's where I begin to be a little bit concerned about the overall health of our market. This market can gradually increase over time. That's really what you want to see it do. So again, if you're looking back here towards the beginning of the year, homes were essentially underpriced and the market just rallied to get to where they should be. And let's look at this for a second. At the beginning of 2021, the payment on a median priced home was less than it was in 2018. I don't care where you're coming from. By pretty much any measure, that means homes are underpriced. And then you look at what happened in that spring. Boy, it jumped so quickly. Then we kind of hit this 115%. Things dove a little bit, and then we've kind of been bouncing around between 110 and 115%. Now we're seeing some gentle rising, but this is not the graph we saw earlier in the year. This is more of an inflationary level graph, and I think this is the market behaving in a rational manner, which makes me happy as an economist. If you look at interest rates too, I think this is something else you need to take a look at. We saw kind of some stair stepping and some rising of the rates. There was kind of this question, is this going to keep going? Then they sort of crested and then they fell this week slightly. When we talk about the speed with which interest rates rise, and I've told you the speed that happens is probably even more important than how far they go. Seeing a graph that looks like this, something that looks fairly smooth, this is important. You want to see a graph that looks like this, that gives the market that time to adjust to that. Anyhow, kind of an interesting time, I think, to be in the real estate business. For all you buyers out there, my heart goes out to you. I think a lot of you thought, great, winter is coming. It's going to be an easier time to buy a house. And instead, we've really seen the opposite, right? It's actually become more competitive than it was, say, late summer. If you're a seller and you felt like you'd missed the chance to get multiple bids and have an attractive house, the answer is you haven't missed it. This is a very, very competitive market. If you're looking to sell and buy, well, those two things cancel out, right? It is also more competitive for you to buy again. The great news is if you're a seller, we're seeing a lot of buyers accepting rent back periods, which then gives you the time to buy your next house with cash in hand instead of trying to organize a contingent sale. Anyhow, thank you guys for watching, and gals. We love the questions, comments, keep them coming. Don't forget to like, subscribe, and hit that notification bell. And then also, if you are looking to buy or sell a home in the Southern California area, especially Los Angeles and Orange counties, we would love to work with you. Definitely hit us up if that's something we can help you out with, or if you just have real estate questions, we like those too. If you're watching on YouTube, we actually have a link to a no cost, no obligation kind of 15-minute consultation that you can schedule. I think I'm covering everything. And yeah, stay tuned later on this week. We have our architectural video coming out on Thursday, and then our first time buyer market update on Friday. So thanks so much for watching, and we'll see you again real soon.